All right. Well, we're in chapter 12, so this is the last chapter. Hopefully, you're still here and happy that we're getting ready to finish the semester. This chapter has to do with a couple wrap up accounting issues and then some analysis along with some ratios. There are a bunch of ratios, but you'll see that I've highlighted certain ones in red. That is so that those are the ones I think are most important. So those are the ones that you really need to be ready to uh, calculate on the test. All right. So sustainable income, most likely level of income to be obtained in the future, differs from actual net income by the amount of unusual revenues, expenses, gains, and losses, including in the current year's income. So what we want to look at is really income that doesn't have any unusual variances. And so that's what we think will be sustainable. So we want to isolate discontinued operations because if you are relying on the cash flow from this company and they discontinue operation, then you need to take into account how that is going to impact the future. Comprehensive income is a something that has a few components to it. It's not really included in net income per se, but it is part of income. So really, that's something that will appear on the balance sheet. We'll talk about that. And then changes in accounting principle. If you change, for instance, the way that you're recording inventory, if you go from FIFO to LIFO, then shareholders need to know about that. Disposal of significant component of the business. Obviously, if you were a company and they got rid of one particular division, you no longer can rely on that division's profits. If that division was unprofitable, that would actually be a good thing. Report on income statement from discontinued operation, two parts: income from operations and gain or loss and disposal of the component. So you talk about, well, here's what we were making and here's what we gained or lost when we got rid of the business. During 2027, our Acro Energy had income before taxes of 800,000. During 2027, Acro discontinued and sold its unprofitable chemical division. The loss in 2027 from chemical division's operations, net of 40,000 income tax savings, was 160,000. The loss and disposal of the chemical division, net of 20,000 income tax savings, was 80,000. Assume a 20% tax rate of income. So you can see that what we're going to be really looking for is this 640,000. That's going forward. And so getting rid of this discontinued operation is actually going to be a good thing going forward. So this should lift the stock price actually. Certain gains and losses that bypass net income are reported as part of a more inclusive earnings measure called comprehensive income. It's the sum of net income and other comprehensive income. If you have shares in a company and you own less than 20%, then you are going to, every time you report financials, you're going to mark that up to the current value. And the difference, if it's a loss or gain between what it was worth last time you reported and this time, goes to comprehensive income. It doesn't affect net income. So here, unrealized gains and losses are reported in other expenses and losses section of the income statement. Available for sale securities, unrealized gains and losses are reported as other comprehensive income. So trading securities, that does get reported, but available for sale securities, you haven't sold them yet, so it's an unrealized gain. So you can see here that unrealized loss on available for sale securities, net of $500 income tax savings. So net income was actually comprehensive income was 298,000, even though net income was 300,000. Many companies report net income and other comprehensive income in separate statements. All right, change in accounting principle occurs when the principle used in the current year is different from the one used in the preceding year. Again, change from FIFO to average cost. Accounting rules permit a change when management can show that the new principle is preferable. Companies report most changes in accounting principle retroactively. So, in other words, you will um, see how it would have impacted the earnings. A high quality of earnings provides full and transparent information that will not confuse or mislead users. Variations among companies in the application of generally accepted accounting principles gap may hamper comparability and reduce quality of earnings. So if one company does their inventory differently than your company, you may not really be able to compare that, especially if it's a situation of rising inflation. Something that started a few years ago is pro forma income. It's an attempt by the company to go, hey, these are gap, and so we will comply to gap and report gap. But here's the real way to look at our company. And in almost every situation, of course, it's going to make the company look better. So a lot of analysts are critical that this is just an attempt by management to make the company look better than it actually is. But sometimes even Warren Buffett, who is the oracle of Omaha and one of the greatest investors of ever, um, does believe that pro forma earnings, that gap earnings may not always tell the whole story. And again, that's why you're looking at cash flow. Most companies will abuse the reporting of revenue and or your expenses. Capitalization of operating expenses. WorldCom did that. So did Health South, the stock I talked about that I lost $3,000 on. Failure to report liabilities, Enron. Even though technically they were probably doing uh, things correctly, they were understating the liabilities by a lot. Channel surfing just means that at the end of the year or end of the quarter, a company gives you a really good deal to buy more than you normally would have had bought. And so that makes their earnings look great at that point, but they're stealing sales from the next year. And so they'll look great this quarter, but then the next quarter we'll see a significant decline because they stole a business. See, we have 400,000 unrealized gain on available sell securities, $100,000 loss from operation of discontinued flour division, or loss from is 50,000. Loss on disposal is 90,000. Income tax rate is 20%. So income before income taxes is 400,000. Income taxes 80,000. Income from continuing operations 320, and then you have the discontinued operations here and see what that effect is. So again, in this case, getting rid of this discontinued operations is going to be a good thing. Okay, so how do you look at a company? How do you compare a company? Well, there are different ways to do that. There's horizontal analysis, which really means you're looking from year to year. And there's vertical analysis, which really means that you're looking at different margin ratios. So you'll look at the gross profit margin, you'll look at the operating income margin, and you'll look at the net income margin. Earnings per share is something that is vitally important, and that is the main criteria for long-term growth. So price earnings ratio, we're going to talk about that. That just basically says how expensive a stock is and also how much growth uh, uh, investors expect out of this company. I bought a stock, NVIDIA, years ago, and it has been uh, the best stock in the last 10 years by far. No question about it. Um, I happened to buy it just because of a newsletter, The Motley Fool, and they said, hey, if you'll join our newsletter, we'll give you the best stock of the 2010s. And so I said, okay, whatever. And they were right. Uh, so it was a great buy, but I was a little too cautious, so I didn't buy as much as I should have, although I did make out very well. And um, the stock recently split, and so they split 10 for 1. And so the stock, again, was selling for $1,200, and now I've got 10 times the amount of shares I did have, but the stock, of course, declined in value. My overall position is the same. So this company has grown gangbusters. In the last earnings call, they grew over 200% in revenue and net income. So they're an expensive stock. They have a PE that's pretty significant. Let me see if I can look that up at this point. Price earnings ratio right now is 70, and the average for the S&P 500 may be 20 or 22. So it's an expensive stock because they expect it to continue to grow. So the PE, the higher PE, again, is the expectation of growth. So you can compare intra-company, intercompany, industry averages. Again, horizontal analysis is just looking year to year. Okay, you can even do like the inflation where you have constant $2010 or whatever. You can just make it. You can compare it all to a base year, and so the current year minus the base year divided by the base year would be the percentage change. So in 2023, that's our base year, and so you can see how much that changes. Net sales increased by 33.6% from 2023 to 2027. Not too bad in 4 years. That's not bad. Of course, as I mentioned, the stock I was just talking about, NVIDIA, they had profit that was twice what they made the prior year. So that's pretty good. Um, so what you really are going to look at is, okay, how did things change? So again, this is related to sales are up 133.6% from this base year. I don't know that comparing something 1, 2, 3, 4 years ago is really legitimate. Things change pretty quickly. But the large increase in net sales during 2024 would raise questions regarding possible reasons for significant change. See, look at here. You go from 10,907 to 11,776. So that's a pretty significant increase. And that's really what we're going to be looking at. Is we're going to be looking at, you know, what changed and why. And then you can also look at the balance sheet. So current assets went up. If that has to do with, well, cash balance went up, that might be a good thing. We invested in property, plant, and equipment. Other assets went up 4%. One thing you are going to look at is probably current or accounts receivable, and we'll look at that. But you want to track accounts receivable to go, all right, if sales went up 10%, accounts receivable went up 25%, that might be an issue. If sales went up 10% and accounts receivable went up 12%, that may not be an issue. You can see here that they bought a lot more treasury stock. Retained earnings went up 31.2%. That's not bad. And common stock went up 24.2. So you're going to really just look at the percentage increase, all right, so we had an 8% increase in net sales. We had an 8.5% increase in cost of goods sold. So effectively, our gross profit margin declined because the cost of goods sold went up higher than the net sales. So our margin declined a little, but maybe that was because we had certain sales going on, which, made our margins decline, but that was on purpose. We wanted to sell more, realizing the more you sell, maybe you have to cut your margin a little. But all in all, we're still gross profits up 7.3%. But given that sales went up 8%, gross profit only went up 7.3, that's another indication that cost of goods sold increased. So I would want to look to see why cost of goods sold increased. And you would just kind of look at all these categories to see if management can tell you why this happened and whether it's sustainable. And here is sort of a analysis that we just kind of looked at real quickly. Vertical analysis, again, we're just looking at percentage of base amount, and it's going to be percentage of sales. Okay, this is going to be percentage of assets. So 23.8% of our assets are current, other assets are 50%. And it really just depends on your mix. And you would just kind of look and go, okay, look at the percentages here. This is pretty even, 26.2, 26.3. So really, other assets went down as a percent while your current assets went up. There's probably a reason for that. It may be logical, and it may not mean anything other than, well, we didn't have. Well, I can't think of a reason right now, but it could be just a logical reason. All right, but you're going to go through that, and you're going to kind of look to go. And so here's the vertical. Again, you're looking at your cost of goods sold. As you can see, the cost of goods sold percentage is up. Not a lot, but it is up. Okay, gross profit is down a little. That's not huge unless you're Walmart, and since you're looking at in the billions, in the $670 billion range, that percentage is significant. SG&A, pretty much right on track. Okay, so we had increased sales and we maintained the same SG&A, selling and administrative expenses. Bottom line is we kept 9.4 cents for every dollar of sales versus last year 9.2 cents. That's better than the other way. And again, if you're using margins, that is better than just absolute value. But you also have to take into account the fact that larger companies probably are going to, if they're in the business like Walmart, where we want to sell you everything, we're going to try to do it at the cheapest price. And so we're going to try to keep our expenses down and have lower margins. So Target probably has better margins than Walmart, but Walmart makes more. So we're going to talk about ratio analysis. And so there are different types. Liquidity ratio just kind of tells you, all right, what do we need to, current ratio, again, we talked about that before, is current assets over current liabilities. And so if our current assets are less than our current liabilities, that number is going to be less than 1. Inventory turnover just basically means how often would you sell your complete inventory? And days in inventory is sort of the reciprocal of that. Same thing with accounts receivable turnover is how often do you turn over all of your receivables? And then what's your average collection period? Now, if your average collection period is 45 days, but your terms are 30 days, that would represent a problem. Whereas days in inventory the higher that number is, the longer it takes you to sell your inventory. So Walmart might go through, so inventory turnover is sort of like, well, if I have this inventory, how many times do I turn it over a year? So Walmart, I believe, sells their inventory 11 times a year. So that means that 12 months divided by 11, so they're a little over 1 month to completely sell out all of their inventory. Free cash flow, again, net cash provided by operating activities minus capital expenditures minus cash dividends. That is a very good indication of the health of a company. And profitability ratios, you have to know these: profit margin, net income divided by net sales. Gross profit is gross profit divided by net sales. Earnings per share is net income minus preferred dividends divided by weighted average common shares outstanding. Price earnings ratio is just the market price per share divided by the earnings per share. And so we're going to look at some of these current ratios. So here is a little more detailed information about how to compute the ratio, and this is in red, so that is an indication that you probably are going to get tested on it, and it's a good indication. So look at this. Again, this company, Chicago Cereal, has 0.67, so they've got 67 cents of current assets to pay $1 in current liabilities. The industry average is 106. So you need to go, well, is 0.67 good or is 106 good, or what does this mean? Accounts receivable turnover, here's the formula. And again, this is a sort of reciprocal. So their turnover is 11.9. So they basically aren't turning it over quite as much, but it's better than the industry average. And effectively, they turn it over every month. So if we're going to use this for the next one, then we're going to go 30 days. Yeah. So it used to take them 29.9 days. Now it takes them, or no. So it does take them 29.9. So this is a good indication. Uh, what is it? Oh, General Mills, got it. Okay. So Chicago Cereal turns their inventory over quicker than General Mills does, but basically it's as if they sell their whole inventory once every month. And again, average receivable turnover. I'm sorry, um, but similar. Okay, so basically they collect all their receivables once a month, which means that their average days outstanding is 30 days, pretty much 30 days. So you can see how those work together. Same thing with inventory turnover. Here, they turn their inventory over 7.5 days. So you divide 12 by 7.5, and that's really going to give you the number of days. So about 46, 48.7. The industry average is 54. So they turn their inventory over quicker than the industry average. And the reason you want that is because the longer things stay in inventory, the more likelihood that you're going to have obsolete products and you're going to have to sell these out. Again, you've seen these sales at after Christmas sales, after Thanksgiving sales, after Halloween sales. If they have items that you use for Halloween and Halloween comes and goes, then nobody wants Halloween uh, decorations anymore. And then some of these are free cash flow. Again, we talked about that before. You should know that. Let's see, they have 556, and the average is not applicable. So their number improved over 2026, not as much as General Mills, but General Mills could be a bigger company. And then again, profitability ratios, profit margin, that just means that net income divided by net sales. So we're keeping 9.4 cents for every dollar we sold. Gross profit, we're keeping 44 cents for every dollar sold to pay for operating expenses and other expenses. Earnings per share is 2.63. We have no preferred dividends, so all of the earnings go to the common shareholders. and there are 418.7. I don't know if this is millions, thousands, or whatever, but they earn 2.63 per share. And so their market price is 52. Now, one thing is when we buy shares back, treasury shares, this number goes down. And if this number goes down, this number has to go up. So companies that buy their own stock, if they keep it off the market, are increasing your earnings per share. And so price earnings, this is 20. So it's a relatively cheap. That does means they're not expecting a high growth rate. So let me give you some other examples of PEs. NVIDIA, as I said, is a PE of about 70. Apple is a PE of 30. So you're basically paying $30 for every dollar of earnings versus NVIDIA, you're paying $70 for every dollar of earnings. Amazon is 52. So they're expecting more growth from Amazon than from Apple, but less growth than from NVIDIA. And Google, their PE is 27. That's a little more expensive. Let's see, Netflix is 44. So investors expecting a higher growth from them. Walmart, PE is 28. So that just tells you basically um, what impact that's going to have. And what happens when you disappoint earnings is that people then, and the PE is it's just because some people want to buy, some people want to sell, and it's whatever they sell at that day. So if they have an earnings disappointment, not only have people have been expecting a higher number and they're expecting a higher growth rate, and that really translates into, well, we're not going to give the PE because we're not going to bid the stock up that much, and the earnings we expected go down. So that has a double whammy, and that's why you see some big moves. It can go the other way if they have an earnings um, up surprise to the good, then they can think, well, maybe they're going to grow faster and their earnings are going to be more. So you get a nice increase in that. All right. Well, this is all the material, and hope you have learned a little about accounting and public companies. And just remember to pay yourself first and invest in that 401k. Put in enough money so that when you're 67, you'll be a millionaire.